the market trading in the green, up over 100 points, but still, it's not enough to really say there's been a significant shift in terms of investments on this market.
Yes, I mean, it's a positive thing for the day, but I don't think we're up this week, and the trend has been largely negative. And you haven't had significant volume on the upside. So we need a few more days to know if this is actually a positive trend.
Okay, now we do watch liquidity by watching the debt management office's debt auctions in the market. October 19th saw 2014, 2015 and 2018 bonds on issue. Talk to us about deals and subscription levels.
Well, I mean, the yields, I believe the yields that came out are the highest, in history of the DMO since 2006. I think initially they had some bonds that had come out at about 15, 16%. But the levels we saw on the 19th, 18% for the 7-year 2018 bond and 16.3 on the 2015 are probably the highest we've ever seen. Now, the subscription level was on the high side for the 2015. But for the 2018 bond, it wasn't like wildly oversubscribed. I mean, just 39 billion subscription, 30 billion on offer. So clearly, it seems as if these rates have moved up for a while.
All right, your outlook for the near term and the future?
Well, I mean, we will need to see some activity on the secondary market to get a good sense for where we are for those rates. These auctions are once a month. The volume in those auctions, the last auction was probably about 60 billion, so it's not a lot of volume. Now, short term, these rates are up, and if we have another increase in November's MPR, then clearly we'll be looking at a higher rate environment for the next few quarters.
All right, now, the changing interest rate environment, the moving in the rates on these papers, what's that going to do for companies that are wanting to issue corporate bonds and also states also wanting to come to the market?
Well, it's a very challenging situation. I mean, in September, we had a number of bonds close, 7-year bonds at 14%. All of a sudden, those rates are looking extremely attractive compared to what we have today. Typically, those rates, when they were at 14, were about 250 basis points over the equivalent federal government bond. If you went 250 basis points above the 2018, for instance, you end up at 20.5%. It's very unlikely anybody's going to issue a bond at 20.5% for now. However, bonds have been issued at that level in the 90s and up to the year 2000. So if we have a sustained high interest rate environment, people will just have to issue at the going rate. But on the immediate term, it's difficult to sell those kind of numbers to any issuers.
Let's talk about the Naira. Trending up at 159 Naira. I'm not really sure what to make of the Naira. There was a time a month ago we were talking about the Naira headed towards 147, and yet it seems to be moving in the opposite direction. News out is that the CBN has moved the forex exposure position from 1% to 3%, and that's having moved it already from 5% in the last MPC. How's this going to impact the markets and if it's going to impact at all?
Well, when that net open position was moved from 5 to 1%, I believe it took effect maybe about a week ago. And so effectively, the banks have sold down their open FX positions. Now they can go up to 3%, so they're probably back in the market buying because it's a function of your shareholders' funds. So if they can take another 2% of their shareholders' funds in speculative FX positions, that's quite a significant impact on the market on the short term. And that might be why we see this trend upwards in the interbank rates.
Let's move on to the equity side. As I said, a slew of results coming through, mostly from the banks. Your impressions of Zenith Bank's results released this week, GT Bank and First Bank in the last week?
Well, they all came out with good results. They're roughly around the same, about almost 50 billion profit before tax. And clearly that's an impressive result in this environment. Going into a higher rate environment, in theory, they should have higher margins on their lending and also higher returns on their investment in government securities. Of course, it's also a function of how easily they can pass on these higher rates to their borrowers. For the real large blue chips, it will be a bit difficult to pass on 3% or so increase. But on the balance, if they can get a rate increase to most of their performing loans, then they should have even better results going forward. Because the cost of money for their deposits hasn't gone up that much.
All right, obviously these are largely tier one banks, and the focus is really on the recapitalization of the rescued banks and some of the smaller banks that have gone into acquisitive deals to try to boost their asset base and also their shareholding. As the banking landscape changes, what sort of performance are you expecting to see from the banks?
Well, again, I mean, a high interest rate environment should be good for them because, I mean, their cost of funds hasn't gone up proportionately. However, they have to be very good at managing their risks, I mean, their portfolio of government securities, because if they were all very long, their money is effectively stuck because they kind of load those securities to take positions in the shorter end. But overall, it's a positive thing for the sector.